Hey everyone, we're here for our next session, which is on PriFi and synthetics, the battleground for the new economy. And I'll let Fabian take it from here.
All right, I'm really excited to be moderating this panel today, together with three very bright minds from the crypto ecosystem, Alex, David, and Rahul. So thank you for taking the time. And the main topic of this panel will be synthetics, of course. But before we talk more about synthetic assets, let's get to know each other first and have a quick introduction round. So Rahul, can you start and introduce yourself?
Sure. Yeah, so my name is Rahul Patel. I work for Hartman Capital, and I specialize in the PriFi or privacy finance segment.
All right, David.
Hi, I'm David Post. I'm Managing Director for Corporate Development and Strategy at Chainlink Labs. Thanks for having me.
Alex.
I'm Alex Ship. I am the CSO at Offshift, which is sort of a leading PriFi protocol on Ethereum. Pleasure to be here.
All right, let's start this panel with an overview of synthetics. So, Alex, could you start and explain to our listeners what synthetics are?
I'm happy to sort of to dive in there. I would say a synthetic is really the most basic form of a derivative instrument. And a derivative instrument is really a sort of contract between two or more parties whose value is based on one or a number of underlying assets, could be a benchmark. And those financial instruments, derivatives instruments, can be quite sophisticated and complicated. For people who are well-versed in derivatives, there are forwards, options and futures contracts, swaps, all the stuff that basically caused the 08-09 financial crisis in one sentence, to be honest, because they can be used very irresponsibly. You can use them to increase leverage and take on risk. They were originally developed really for the purposes of reducing risk and managing market volatility. I think the easiest way to think about it, what a derivative is talk about synthetics, because synthetics are the bare bones, the simplest form of what a derivative is. It's an asset it's a carbon copy, it's a digital copy, I should say, of an asset which exists somewhere else, whose price is linked directly to that asset in real time. And which can be exchanged at that price. So the simplest form of a synthetic, really, the original in crypto might just be USDT Tether or USD coin. They aren't actually dollars, but they are synthetic versions of dollars. And so the concept of a synthetic asset should not be intimidating. It's something that everyone from within and beyond DeFi can certainly understand.
All right, Alex, thank you for the overview. And let's go on and David, could you give your view on what kind of role synthetic assets currently play in DeFi?
Yeah, I think so. As Alex mentioned, synthetics play a very important role in DeFi right now. Most people interact with them every day. They don't even know it because what is synthetic? It's a derivative of something that exists somewhere else. It's basically a representation of value. So I think that synthetics are currently used on a very widespread basis within DeFi, and I think that use will continue to increase as there's different types of assets that are brought on chain.
Rahul, any comments?
Yeah, sure. I think diversification is also a key point where before all you could really do is invest in speculative crypto assets. But now with the advent of on-chain synthetics, investors have the ability to diversify their holdings and stay in the ecosystem, the digital ecosystem rather, which should grow the entire crypto market and specifically DeFi.
Yeah, okay, cool. And now that we know what synthetics are and what their role in DeFi is, let's go on and talk a little bit about two different types of synthetics, custodial and non-custodial synthetic assets. So, Alex, could you explain to our audience what the difference is between those two types?
Yeah, and definitely, there's a gray area in between too, and then there's kind of a spectrum there. But I think custodial, again, to just tie it back to USDT, Tether, USDC, USD Coin, those are the simplest to understand, especially for people that aren't super well acquainted with DeFi, which is that there are asset-specific reserves to back those synthetics. So for dollars, and in other words, for USDT, there should be dollars held in a bank account or a series or network of bank accounts somewhere for each USDT that is released, that's minted, issued on chain. The same for USDC. And in recent reporting or attestations that those two companies or two projects have done, they're not exactly one-to-one backed, and that's why I say they're not necessarily non-custodial, not necessarily custodial, but they might have commercial paper, they might have other money market stuff, and it's not totally transparent in every case. But that's the concept of a custodial. Like, for example, if you wanted to issue a synthetic share of Tesla, you'd actually have to buy one and own one, and then you could issue it on chain. There's custodianship there, and that is inherently more centralized. A non-custodial, or what I would also refer to as an algorithmic model for synthetics, is where you have sort of a basket of digital assets that are all put into some sort of pool, and then from that pool, synthetics can be minted. And again, how much that can be minted, it depends on how much ETH or BTC or whatever kind of digital assets have been put into the pool and how much by one particular user. MakerDAO is probably, again, the prominent, most early stage project that has sort of non-custodial algorithmic model where you can mint DAI, which are pegged to the US dollar, but unlike USDT and USDC, there is no bank account whatsoever. There are no dollars behind them, and it is far more decentralized. So there are some advantages there that, in terms of decentralization, you're not relying on some entity in their bank accounts and their honesty, so to speak. On the other hand, though, in these sort of non-custodial solutions where you can mint synthetics out of a pool, you're dealing with the volatility of the underlying assets. And so there are some concerns with over-collateralization, with liquidation, with margin calls and things of that nature. And that's where you get into, I would say, more sophisticated and more complex territory where you really need to be an advanced trader and you see more complex forms of derivatives coming out. I think like synthetics, compound, mirror protocol, those are examples of projects or protocols that offer non-custodial synthetic assets that are a little more advanced.
Rahul, what are your thoughts on custodial versus non-custodial synthetic assets?
I think Alex summed it up pretty nicely. I have nothing else to add. That was a great summary by
Yeah,
Alex.
that was a great overview indeed. So let's go on and talk. Let's go on and talk about how those both types of synthetic assets impact our financial system in a different way. So, David, could you give us your thoughts on that?
Yeah, I mean, I think in the mainstream, financial system, I think this applies in the DeFi world as well. There's a couple of ways that synthetics improve the financial system. So there's the funding aspect. So synthetics can obviously lower funding costs. There's liquidity creation. So basically, synthetics can be used to inject liquidity into markets, which reduces costs for investors and makes markets more efficient. And then there's obviously the issue of market access. So if you have synthetics, then people can more easily and freely participate because you can create cash flow off of different types of securities through a combination of instruments and derivatives. So I think that synthetics obviously are widely used and widely traded because there are advantages from a financial perspective and from a trading perspective of having them as part of the financial system.
Yeah, I'd like to bounce off that if I can, because I certainly agree with you there as far as injecting liquidity. I also think that synthetics are really, really interesting because they kind of create a free market for markets. Where typically, you have a marketplace and it's difficult to build one and it needs to be centralized and there are a lot of costs involved. But when we see these systems built on blockchain that are distributed, it's a lot easier to build marketplaces, but it's also easier to build assets. When you have identical assets that exist across different markets, you start to see the markets competing and you start to see a much more level playing field emerging. And that's where it gets pretty exciting because that's sort of the first space where the what I would call centralized incumbents begin to compete with these sort of emergent decentralized systems built on blockchain. You have something like Bitcoin, for example, which competes with the US dollar and other fiat currencies. but not in a direct way. It's quite indirect. And Bitcoin's volatility and other factors involved with transacting it are sort of, I don't want to say repulsive, but are definitely not appealing to many people that are looking to enter the space. Whereas when you have stablecoins entering the space, that kind of get rid of the complicated stuff and keep the 24-hour access, the low cost of trading for international transfers, that sort of stuff. And so it really is creating a level playing field again, not just across assets, but across markets. And I think there's a lot of really exciting stuff that's going to come out of that.
Yeah, I think, Alex, what you're saying, I think it's kind of like people take synthetics for granted, right? Because I think, like as we talked about at the beginning, we're interacting with them. We don't really know we're interacting with them. And they're providing a range of benefits in terms of how we're able to access different financial instruments or trade or just have a better financial system.
Yeah, and a more open financial system.
Exactly.
All right. The next topic of this panel is privacy. And privacy is a super important topic, especially in DeFi. And Offshift and Chainlink actually work together on a fully private synthetic solution. So could each of you comment a little bit about that in terms of how does privacy in synthetics work and why is it important? Maybe Raul, can you start?
Sure. Yeah. So in regards to why privacy is important, especially from like a hedge fund perspective or any investor perspective, you have services like Nansen that are designed to identify and label public wallets on open blockchains like Ethereum. And so these services enable users to track where institutional funds are moving money to and trace transactions to a very granular level. And so this is detrimental in terms of preserving our alpha as a hedge fund. We don't want our trading strategies in DeFi to be public to everyone. And this is where privacy preserving applications such as Offshift offer solutions to help mitigate the disadvantages to the open nature of the blockchains. Disadvantage in the sense that anyone can view what you're holding and how much of what you're holding on Ethereum. And so, for example, if I see forthcoming turbulence in the market in the near term, I can transfer funds into a protocol like Offshift and get price exposure to a low beta asset like gold to protect myself from the possible forthcoming volatility without the rest of the market knowing exactly what I'm doing or what my hedging strategy is.
Yeah, I'm glad you mentioned that because I think privacy really does get a bad rap, where it's generally associated with sort of unlawful activities and generally, malicious and immoral activities in general. And there is significant demand for privacy from institutions, other organizations, various businesses, and of course, individuals. Whether they believe in the sort of you'll sell your data and packages and NFT and data as an asset, or if it's just for personal reasons and one's own principles, people with a more libertarian philosophy. There are a lot of different peoples and a lot of different, I would say, demographics that are interested in privacy. And again, building a system that can offer privacy is really powerful. And synthetic assets play a major role in that because if the system is imbuing the assets with privacy, again, it calls into question this sort of mind-bending dilemma about what makes an asset real in the first place. And if demand starts to migrate from traditional platforms or even other platforms within the blockchain space, and they're purportedly real and purportedly scarce assets into synthetics, which are directly pegged to them, but which confer a superior user experience, perhaps in the form of privacy, perhaps in the form of other features, which I'm sure we'll only begin to see more and more of as the space continues to evolve. But yeah, privacy is a really big piece of the puzzle. I don't want to take too much here. I'll let David jump in. Although I certainly have other things to say.
Please continue.
Okay.
It's a good. You're going in a good direction here.
Okay. Yeah. I mean, I don't want to step on your toes here, but I think like the biggest part of all of this really comes down to Oracle Network. So I also don't want to blow smoke up your nose over there, but I mean, it really is true. It's like, how can you get, it's not just on-chain data either. It's really, I think, more so for the off-chain data, because decentralization, I mean, we could have a 4-hour panel here on what decentralization actually means. And how it really is at this point really is such an abstract concept. But as far as sourcing, if even sourcing data from anywhere becomes a centralized process, then you have a single point of failure and the whole system breaks down. And so again, then those synthetic assets aren't going to be worth anything at all, because the system isn't really conferring them with the features that it was designed to. So I think, privacy is definitely going to be a big part of this space going forward. What actual privacy is, and then of course, which those price feeds and how they're generated, and the Oracle network as well. But yeah, I'm sort of leading into your piece there.
No, I mean, I appreciate that. No, it's a partnership, so you can, we could both talk about both of these aspects, right? So or collaboration here. So I think that's exactly right. I mean, what Chainlink Labs has done, and Chainlink as an Oracle network is basically, I think, provided that underlying robust set of decentralized data to have people have the confidence they need to transact in synthetics and also other types of the DeFi applications. So what Chainlink as a network does is we're basically, for folks who don't know, we're basically the one of the largest providers of data external data to DeFi applications. Smart contracts are called smart contracts, but they're actually dumb. And the data that we provide in a very robust way, that's decentralized, that's highly validated, that's highly accurate, allows applications that utilize synthetics in a decentralized fashion to effectively operate. So the role that we play in this is to make sure that when you're interacting with a synthetic and you're trading between synthetics, that is based upon information that is powering smart contracts, so those transactions happen in an accurate way and in a very high integrity way.
Yeah, well said. Well said. And I think the other part there is that, again, they don't compromise the capacity of any particular protocol to confer privacy to those assets, in particular to synthetic assets. Thank you to the advent of zero knowledge and the applications of zero knowledge proofs, which, just for anyone who's not familiar with zero knowledge proofs, they sort of allow a prover in some way to prove to other verifiers, in other words, a person to prove to other people that they know the content of some piece of information without exposing that information directly. And I think that's really a huge part of any privacy protocol as well. And obviously, it's going to play a major role in any privacy promoting or privacy protecting synthetics protocol too.
I think it's just interesting for the folks listening in. It's just that you see the composability here of various parts of the stack. I think that's what Alex is referring to. So what's great about DeFi is that you can combine these things, these capabilities and these kind of protocols and technologies in different types of ways to get the outcome you want to. And I think that what Alex has alluded to is a very interesting combination of a variety of technologies that have allowed for PriFi and synthetic assets to basically be used at scale.
Wow. Okay. Yeah. That. Yeah. Certainly. Yeah. And I mean, I will say that I mean, there's certainly a place for public and transparent systems. There's certainly a place for private systems there, and composability and flexibility and versatility in the development process is what's most important. I think the space is sort of the entire space that is built on, and is moving towards interoperability and coexistence and that sort of thing. And that's what inclusion should really be about. So, we're not, I certainly, there's a great quote from Glenn Greenwald that I always like to tap on, which is that it's something along the lines of transparency is for people in positions of power and public duty, and privacy is for everyone else. But it's just to say along the lines that there are different times and places for different kinds of protocols and different kinds of rules and different kinds of incentive structures. And there's not a one size fits all.
That's what makes the industry very interesting, right?
Yeah, it is. It is. Yeah, very.
Absolutely.
Yeah, definitely. And I mean, privacy is also part of the decentralization of our industry in general, because it's about having the choice. It's like having the choice to be private or public. And yeah, that's why I think especially privacy in synthetic assets is a very, very interesting topic that will also shape the future of DeFi. And we can be excited about what's to come and what you guys are building at the moment. So let's get to the last topic of today, which is how synthetics could actually impact our financial system. And my last question is, how could synthetics actually trigger a radical upheaval or sudden change in this extremely unstable financial system that we currently live in today?
Yeah, I mean, sorry, go ahead. Sorry, I just jumped in there.
Alex, start.
Yeah, I mean, there are so many things that could happen, and it's not. I wouldn't say it's really like to say a radical upheaval. I don't think there's any attacking going on or again anything malicious. I just think again like the example between like the dichotomy between Bitcoin and fiat currencies. There's still a distance there, and there's no real incentive for banks, financial institutions, and again in sort of the equity space like stocks or anything, companies to migrate shares to blockchain infrastructure, especially to decentralized infrastructure. And that crypto has, as much as it's developing very rapidly, has for quite a long time been on sort of its own island. And synthetics are really opening up that bridge by creating identical assets in parallel systems. I think there's a lot of room for financial turbulence in there, both as far as custodial synthetics and non-custodial synthetics. Like in particular with custodial synthetics, again, just sticking with, for example, stable coins. If you look at Tether and USD coins combined market capitalizations, they're now over $100 billion. That's not including Binance USD, which is I think from Paxos. And so you get to a point where some of these like emergent crypto applications, protocols or platforms are picking up and just storing more dollars or as many dollars as bulge bracket banks, as premier financial institutions. And so that's where you start to see some competition starting to take shape when you see extremely competitive interest rates, or what I would say beyond competitive interest rates. And those are the kinds of things. If you're just getting interest on your Bitcoin, there's still a gap there. But when you're getting interest on your synthetic US dollars versus the interest you're getting on your real US dollars, there are a lot of people that would normally be standing in the middle, or that would be, again, nervous or averse to entering the crypto space. That pushes them over the edge. And they're like, all right, this is pegged to a US dollar. The interest rate is literally 80 times higher. I'm going to give this a shot with some of my money. And that's when they start to get acquainted with the ecosystem. I would say, on the non-custodial side, there are even sort of greater forms of turbulence that can take form, especially for stocks, for example. I mean, if you have synthetic stocks that are being, again, minted out of algorithmic protocols, meaning that the protocol, like mirror protocols is one example, not trying to, toot their horn too much, but it's a project that has a lot of synthetic stocks. And they're obviously not buying stocks underneath that. So what's happening is they're just minting these synthetic assets. So that's really sucking in demand. They're usurping the demand that would normally be going to the shares of these Fortune 500 companies, some of the most valuable countries in the world, and they're effectively inflating the supply of those shares and therefore suppressing the price. So, at some point you have these like sort of C-suite, C-level executives getting into a call with the guys from the members of the board talking about what's going on with the share price and why we're losing 10% of our aggregate demand to crypto protocols. And at that point, I think there's a conversation that has to be had about, okay, maybe we can migrate some of these shares to some sort of blockchain system so that we can prevent this sort of, like artificial supply expansion or natural supply expansion. And so, I mean, to me, the turbulence is kind of an inevitability, like the sort of clashing between these two spaces and the transition from, existing infrastructure to decentralized infrastructure as being some form of an inevitability. But I think, synthetics is really where that begins to take form.
So, Raul, any comments?
No, again, very comprehensive outlook by Alex.
No, thank you.
David?
Yeah, I mean, Alex did a very good job. I would just say it's the, it's early days on this. And I think that's what Alex is pointing out. I think that 10 years ago, the idea of pressing a button, having a stranger come and pick us up in their car would have sounded pretty insane. I don't think that, this whole synthetics conversation is in that realm even at this point. But I think the question is especially for kind of non-custodial synthetics, as Alex mentioned, what does it mean when you can just trade a representation of the asset, and that happens at scale? And what's the interaction with the other asset that exists in the real world? So I think there's going to be a lot of interesting questions. One thing I found working in this space is it's guaranteed never to be boring, and I think as this continues to unfold, there's going to be opportunities for innovation. There's probably going to be challenges that pop up, but that's what happens when you're kind of creating new ways of transacting.
Yeah, I mean, I see that Steven here on the side has commented that USDC wants to offer 4% yield with dollar assets backed by commercial paper, and that's a real risk. And yeah, I mean, I'm not going to comment on their their financial standing, but the fact that you can say that and make that decision as sort of a conscientious investor instead of seeing flat the same interest rates across the board, you can analyze their attestations, their financial statements yourself, and determine their interest rates. We're starting to see a lot more variability that's offered because there's so much more flexibility in these protocols. And again, so even if you look at USDC and you don't like what they're doing, well, there are a whole lot of other competitors in the space. If you don't like USDC, you can look into all of these different stable coins. And then, of course, you have the synthetic platforms like Compound and Synthetics that have their own USDs. And then they have synthetic USDCs too. So you could get your C tokens or whatever that are their synthetic forms of USDC and those interest rates. And so I think it can get into a really crazy place. And it is important to say that as exciting as the space is and that it's never boring, it is important to take care with your own capital when you're investing because this stuff is experimental. It's exciting, but there are no guarantees, and freedom and responsibility are different sides of the same coin.
All right, guys. I think we've come to the end of this panel, and so my very last question is, who of you guys can give us a little summary of what we learned today? Who's brave enough?
I mean, Rahul is the privacy expert, so. The PriFi expert.
I think I'll let Alex take this one. I think he's very articulate.
Thank you. Yeah. I mean, I think as I really think that anyone who's kind of looking to get ahead of the curve, and I'm saying this as carefully as possible, because that doesn't mean anyone who's going to make 100x or anything like that. I just mean if you're looking to understand this space and where it's moving, I think synthetics are a lot more. They're as David alluded to, very early on in their development, extremely early on in their development. But they are sort of like they're sort of a starting point that a lot of stuff is going to emerge out of. The whole concept of synthetics is, and I think DeFi was a really exciting concept. And in the beginning, people thought lending and borrowing pools were going to be the big thing, but and they are, but I think synthetics is like the key element, the key component in those pools that's really driving a lot of the innovation. And that's where a lot of the creativity and the experimentation is really seated, is in what can be done with synthetic assets and all the different ways they can be integrated into different protocols, what they can represent. If you throw NFTs into that mix, it gets really wild. So if anyone's kind of entering DeFi or entering crypto, and they just see an overwhelming body of information and all sorts of different stuff going on Twitter, I think diving into synthetics a bit is a really good place to start. And you can be really certain that 6 months, 1 year, 2 years down the line, you'll be really glad that you had that foundation in synthetics because you'll really understand where the space is moving as you start to get familiar with it. If I could try to summarize everything, I just say synthetics are just really, really, really simple derivatives. They're just identical digital copies of assets that exist elsewhere. And they are powered by a decentralized network of oracles always, and those price feeds are crucial. But if you have those in place, you can mint such a wide array of different assets that otherwise would be totally untouchable within the crypto ecosystem. And that keeps capital in the crypto ecosystem. That keeps a lot more developers as a result. It keeps a lot more organizations, and it powers further innovation. So there's this kind of positive feedback loop of people staying in the space because there's so much more going on. And then that capital powers more innovation. So as there are multiple kinds of synthetics, we talked about custodial, we talked about non-custodial, and we talked about how they could sort of shake up the existing financial landscape. I certainly don't have any predictions, but I think, as David said, it will not be boring. It will be extremely interesting.
Wow. Thank you, Alex, for the nice last words. And yeah, 2 minutes early, but I think we finished this panel. Thank you so much for listening, and special thanks to our panelists here. You did a great job. if you want to find out more about what I do, you can just search DeFi Times on YouTube or any podcast app. You will find us. But now I hope each of you has a great day. And I really enjoyed this conversation. And yeah, goodbye, guys.
Thanks for having us.
Thank you.
Thank you.
Thanks
It's a
so
pleasure.
much. All right. We'll see you guys on Monday at 7 a.m. Pacific. And thanks again for speaking. Bye.
Thank you. It was a pleasure.